Hi, I'm Mr. Simons, and in this video we're going to be looking at financial ratios and we're looking at profitability ratios. This is targeted to the New South Wales Business Studies HSC. Well, I really had to remember that for a second. So if you're not sure whether this is the same content that you need, I put a link to the syllabus in the show notes. What we're thinking about with all this is that really the main goal of a business is to make profit. All of the other things really stem from that. If a business is not making profit, it can't survive. All the other stuff is nice, but without a profit, it can't survive. So if we think a very basic kind of understanding about profit, profit equals revenue minus expenses. Profit equals what is earned minus its costs. So that if we are in a business and we own a business, that we're really concerned about profit because it's important to survival, but it will be used to reimburse the owners through dividends. So they will get those rewards, and that also profit is really important to create future opportunities for growth, that the business will likely retain some of those profits in order to fund future growth. When we are analyzing profitability, there are three ratios I'm going to discuss. I've got gross profit, not gross profit, a gross profit, net profit, and return on equity. So we're just going to roll through each. So let's start with this gross profit thing. So we're going the gross profit ratio. So in order to think about the ratio, first we've got to think about what gross profit actually is. So if we think about gross profit, that what it is it's the profit after taking away the direct costs in selling its products. Now that sounds a bit complex, but what we're essentially saying is we're taking COGS away from what is sold. So if we think about an example, so let's say that this business sells $1,000 worth of products, so that is our revenue. And then it costs $400 to organize those sales, so that the gross profit is $600. So the business sells $1,000 worth of product, that's the revenue. The cost of selling those goods is $400, so the gross profit is $600. So if I then think about, well then what is the formula here? So it's revenue minus COGS. We are taking away those direct costs of selling the product. If we're looking at the ratio, I think the best way to understand it is that for every dollar we sell, after COGS is taken out, how much profit does a business earn? So the ratio is really telling us how large is COGS in relation to revenue. How much are we spending on selling the goods compared to what we actually get for the goods? So let's think about this. Let's say that the gross profit ratio is 20%. Gross profit ratio equals 20%. What that's telling us is that COGS here is taking 80% of revenue, and we might not be very happy with that. Why do I say this? Not the happy part, but these numbers. Because the gross profit ratio equals gross profit divided by sales. So if the gross profit ratio is 20%, after this calculation, that what we get is that the profit left over is 20%, which means that 80% has been taken by the cost of selling this stuff. Let's try an example. Maybe that was a little bit confusing, which is fine. So a company earns $400 from sales. So then I'm thinking, okay, so that's revenue. And then the cost of goods sold is $100. Okay, so then I can go to my gross profit formula and I've got revenue minus COGS equals 300. So then I'll go over here and I'll say, okay, my gross profit ratio equals gross profit over sales. I know that my gross profit here is 300. So gross profit is $300. So the revenue minus COGS is 300. and that I know that my sales is 400. So that then this gives me 0.75 or 75%. I shouldn't put a line there. So that gross profit here, the gross profit ratio is 0.75 or 75%. So what we're saying is that for every $1 of sales, right, for every $1 of sales that's earned, that the company receives gross profit of 75 cents. That's pretty good. It's definitely not 20%. So just to say this one more time, so we're looking at the gross profit ratio. So we're looking at our gross profit, which is revenue minus COGS, and then our gross profit ratio is telling us that profit, what is that in relation to sales? For this company, we're saying that gross profit is worth 75% of sales. Great. What an amazing figure, because we want this result, this ratio, to be as high as possible. We want, as a business, to be making the most profit possible compared to the level of sales. Okay, so that was gross profit. Now let's go to net profit. So before we get into the ratio, let's go back to the concept of net profit. So net profit is sales minus everything, all of the other costs. So if I look at here, I'm like, okay, so gross profit, that there is revenue minus COGS. This is minus all of the costs that are involved, so that this is the total amount. So that if I think about why do I care, this is the overall profitability of the business, not just gross profit. This is the whole thing. So if I'm looking at it here, if I get a result of, say, net profit is 15%, what I'm saying here is that for every $1 of sales, that 15 cents is held as net profit. So it's okay. I probably would like that to be a bit larger, but it's okay. So our net profit ratio is net profit divided by sales, and this whole net profit thing is calculated by that. If we try and do an example here, if a business has got $400 of sales, COGS of 100 and expenses of 200, so then I would say, okay, so net profit, right, would equal revenue or sales minus expenses. So here I would say, okay, 400 minus 300 would equal 100, because both of those fall into the expenses. And then I would think about, okay, what is the net profit ratio? Well, that's net profit over sales. And then that is going to equal 100 over 400. So that will equal 0.25 or 25%. So that's a 4, not a 9, that's a 4. So for every $1 that this business earns in sales, 25 cents are kept as net profit. So that's okay, depending on the business's goals. So let's do an example, and you can see that the source for this example is given here. So what we've got is we've got two questions: calculate the gross profit ratio and the net profit ratio, and to show working on both. So you can see here we've got an income statement. We've got all the numbers here, which is helpful. So let's think about gross profit to start with. So if I look at the gross profit ratio, so the gross profit ratio, that is going to equal gross profit. What is that? That's embarrassing. Gross profit over sales. We don't know what gross profit is here. So what we need to do is we'll go back to gross profit. Okay, so that's going to equal revenue minus COGS here. So my revenue is 100K. So 100,000 minus cost of goods sold is 80,000. So this will equal 20K, and that's dollars. So gross profit is 20,000. and then sales is 100,000. I'll just put the full numbers so it's not too confusing. And then here that will equal 0.2 or 20%. So for every dollar that's sold, this business keeps 20 cents in gross profit. So now let's have a look at what happens to net profit. And I would expect that net profit would be lower because there are going to be more expenses. So here we're just minusing COGS. Here we're going to minus a whole bunch of other expenses too. So the net profit ratio would equal net profit over sales. Revenue minus expenses, fine. And you can see that that's the revenue. Here are all the expenses, and here is net profit. Net profit here is 15,000. So then I can say, okay, so net profit is going to equal 15,000 over sales of 100,000, which is going to equal 0.15 or 15%. So you can see here for every $1 of sales, the business will keep 15 cents, which is lower than 20 because there are more things that reduce profit in terms of those expenses. So this is how we would do the calculations for the gross profit ratio and the net profit ratio as well. So our final ratio in terms of profitability is the return on equity, or ROE. Not ROI, that's something different. So that what we are thinking about for the term equity here is we are thinking about the amount of money that has been invested by owners into the business. So debt, that is an external source of finance. Equity, this is an internal source of finance. So when we're thinking about this ratio, that total equity here is the total amount of money that owners have put into the business. So that if we want to put it even more directly, we're talking about the dollar here, dollar there in the previous ones, we're saying that for every dollar that owners invest, how much do they earn in net profit? What is their reward in terms of their investment? So if we look at this ratio, what we're saying is return on equity is net profit over total equity. So net profit being revenue minus all expenses, and then here divided by total equity. So let's have a think about an example. So let's say that a business here has net profit of 15K on total equity of 150,000. So here we would say, okay, so the return on equity, net profit is 15,000, and then this is divided by total equity of 150,000. So that what this would be is that this would equal 0.1 or 10%. 10%. So what this means is that for every $1 of equity contributed by owners, they received 10 cents in return. So a 10% return. So you might think, this is good, or this may not be good. So this may or may not be a reasonable rate of return, because think about it. An investor can put their money in a whole bunch of different places. So if they're getting 10% on their investment in the business, that might be much larger than what they can get from a bank account or even the share market. If it was the other way around, if return on equity was maybe like 3% or 2%, they might think about, should I stay in the business or could I put my money elsewhere? And that's really about the point that I'm making here. So that the higher the return on equity, the better the return for the owner and the more likely they'll keep their money in the business. So in terms of this video, we've looked at the financial ratios for profitability, remembering that the main goal of the business is to earn profit. So that the ratios we've looked at are the gross profit ratio, which is revenue minus the cost of goods sold. We've looked at the net profit ratio, which is revenue minus all expenses, and then the return on equity ratio. For each dollar that investor puts in, how much are they getting back in terms of their reward, in terms of profit? So I know this one is tricky, a little bit complex. If there are any questions or issues, put them in the comments. And as always, thank you very much for watching.